Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Zach Unger, Senior Analyst. So thankful you joining us here as we come off of Labor Day. Hope everybody had a great one. College football back underway, which makes Zach happy, which makes me happy. Spend most of my falls down in Bloomington, so hopefully we can keep those W's going, but look a little bit better. So that's enough of the college football for now. We'll talk about this week instead corporate bond spreads. We'll talk about mortgage rates and M&A activity. So 3 topics for you here, heavy on the bond side, and then of course on the private markets, which is really where Zach's specialty has come over the years. All right, so let's dive in and talk about corporate bonds, which is important for a few reasons. One, it has portfolio implications, particularly for those conservative leaning orients, which have a decent bond allocation, but also as it leads to investment analysis for the broader landscape. And so what we're looking at here is the incremental yield that is attached to corporate bonds as opposed to treasuries. So when you invest in corporate bonds, you're taking on the risk of that corporation being able to pay you back. And the more risky you are, the more extra yield that you have to pay on that bond to compensate the investor for that risk. But as you can see, that is not a steady line over time. There are times when the market requires more yield, and there are times when it's more sanguine and it requires less yield. And that's where we're at right now. In fact, we're at the lows that we haven't seen since right before the great financial crisis and then back into the 1990s. So what does that tell you what's going to happen going forward? Absolutely nothing. But what it does do is it tells you what type of risk reward that you face for corporate bonds. And it tells you that the risk appetite is really healthy for the macro environment as a whole. So we are leery of investing in corporate bonds right now for that reason. It doesn't even take things to go haywire. It doesn't take a recession environment. It just takes a repricing of risk to produce some losses in those bonds. Now, when this begins to turn and reverse and go back up, investors will start requiring more and more yield for their bonds. That's when we begin to feed into our risk barometer. That is one component of it. That begins to feed credit conditions on the negative side. But for now, investors are pricing in basically smooth sailing ahead. So we will monitor that at least weekly, but it's something that's on my radar each and every day. So I'll pass it over to Zach to jump in and talk about mortgage rates.
Now, the mortgage landscape in the residential space has been interesting over the past couple of years, really. We got elevated interest rates on the mortgage front. You can see on the right-hand chart there, up over 7% for your average 30-year fixed mortgage rate. But really over the past year, we've seen those fairly steadily decline. We did get a bump in June up near 7, but not quite there. Down below 6.6%, the lowest they've been all year. This has implications for many of you. Some of you who locked in very low mortgage rates in the 2020 years, and then some of you who bought with higher interest rates following those years as interest rates came up. The chart on the left hand is particularly interesting because we've been in a period with high interest rates where residential mortgage activity or the transactions, people buying and selling homes, has been really muted for quite a while, in large part because mortgage rates are high. And so it makes it less feasible for people to sell a home and then buy a new one, knowing that they're going to have to take out a mortgage with a much higher interest rate. So people tend to just choose in those environments to stay put. We've seen that bear out in the data where there's just not much transaction volume. However, on the left-hand chart here, you can see that if we get down into the 6.25 area, it becomes very advantageous for many, many more Americans, upwards of about 6 million, to refinance, meaning that they can lower their interest rate substantially with a refinance to the point where it makes economic sense for them to do so. That also makes it possible for people to start selling out of homes. Interest rates coming down makes it a little bit more feasible for them to switch without taking on a much higher mortgage. So if mortgage rates continue to come down, or if they drop another 50 basis points or so, we may see that flow into the real estate market on the residential side, start to see some of that activity pick back up. Continuing the activity trend, this is in the private market space, particularly for M&A. M&A activity is a really good indicator for us, particularly on the private equity side, similarly on the private credit, but primarily on private equity. When we see M&A activity pick up, it is very advantageous for private equity because we know that businesses are moving. Coming out of 2021, you can see their all-time high in terms of total activity on the M&A front. Really, really large there coming out of the COVID crisis. And then 22, 23, and really 24 as well, even though we did get a slight uptick. Those 3 years, we saw substantially muted activity in the M&A market. It was hard for the PE sponsors to find liquidity, to return capital to investors, which makes it harder for them to raise new funds, to do deals, et cetera, et cetera. And really what that means for the actual private equity portfolios is that it's hard for the value of the companies being held to actually be realized. So you might have a company that is valued more than what it's held on the books for, meaning that there's unrealized gain in the portfolio. But if there's not activity, then it makes it hard for that value to actually be recognized and to flow through to the investor. And so you can see on the right-hand side here, circled in the red box, the first half of 2025, we are back up to 22 levels. And so the activity is certainly starting to pick up, coming off of a really down 23 and 24. We're seeing some acceleration. And the visibility we have into the second half of 25 already, that trend appears to be continuing, that we will have more M&A activity, which bodes well for private equity as a whole as businesses get moved and some of that unrealized value in the underlying portfolio starts to flow back through to investors. You've heard us talk often about Core Plus. It's been a big initiative of ours this year in particular, getting allocations to private markets, private equity being part of that. So as this M&A activity continues to move in the right direction, it is certainly likely that we'll start to see some of those values rise alongside.
Excellent, Zach. Thank you very much. And it really just caught my eye to see, because honestly, living through the first half of this year, I wouldn't have thought that the activity was higher. Certainly for the year 2025, the optimism was there for a lot more deals getting done. But the choppiness and the uncertainty we had around tariffs, the fact that we surpassed that is a very good sign for that space. Not only that space, but some of the investment banks that deal in there and generate their income from advising such deals. So thank you. And thank you to all of you for giving us your time. As always, if we can be a help, don't hesitate to reach out 800-928-4001 or scan the QR code and do so electronically. Thanks and have a great weekend.